The Economic Club of Minnesota's mission is to provide a world-class, nonpartisan forum for national and international leaders in business and public policy to discuss ideas that affect how Minnesota can better compete in the global economy. The Economic Club of Minnesota, engaging the world, strengthening Minnesota.
Wonderful to be back in Minneapolis. Can everybody hear me? It sounds like it's plenty loud enough, but I have a pretty booming voice anyway, so sometimes I don't even need to be mic'd. I came up to Minneapolis pretty frequently when I was in graduate school because my brother went to University of Minnesota. So I had the opportunity to go to the Guthrie. I had the opportunity to enjoy the lakes in downtown Minneapolis, and particularly the wonderful way that everybody in Minneapolis cherishes the sun whenever it does come out. And I guess today is one of the few days so far in the spring that you've actually saw the sun, so I'm glad I was able to bring a little bit of sun, and hopefully my presentation will bring a little bit of more sun, because I'm going to be fairly optimistic in my talk today. I would also like to thank Mark Olson for inviting me here, and I want to particularly thank him for inviting me for May rather than January. So thank you very much for that. The topic I'm going to talk about today is going to be focused on monetary policy and the economic outlook right now. If your back is to the slides, you might want to shift your chair around because I am an economist, I love data, so some of my slides are going to require you to probably look at the screen. So if your back is to the screen, you may want to change that. And so to start off with, I want to talk a little bit about the progress that we've seen since last September, which is when we started our large-scale asset purchase program. So since last September, at the September meeting, the unemployment rate at that time was 8.1%. Very high unemployment rate. That was the August unemployment rate at the time we were making the decision. And the expectation, both of the Federal Reserve and of the private sector, was in the absence of taking more aggressive action, we were going to make very, very slow progress towards getting that unemployment rate down. So as a result of that meeting, the September meeting, we decided to start purchasing mortgage-backed securities. And then in December, we added to that purchases of Treasury securities. So since January 1st of this year, we've been purchasing $85 billion of Treasury and mortgage-backed securities per month. So a fairly large sum of money that we've been purchasing regularly in order to try to stimulate the economy. The basic idea is that we're trying to take duration out of the market, which is just basically flattening the yield curve. So that we can't do anything at the short end of the market because those interest rates are close to zero. But we can do something at the long end of the market. When we buy mortgage-backed securities, when we buy Treasury securities, it has the effect of flattening the yield curve. That should help the housing market. That should help any kind of durable kinds of purchases. And in fact, since last September, if you look at the areas of the economy that are doing really well, it's housing. Housing starts have been quite strong. Housing prices have been moving up. Auto sales are back to where they were prior to the recession that we had. So in terms of interest-sensitive sectors, those sectors that monetary policy should have the most impact on, we're actually seeing a fair amount of impact. So for those people that are skeptical that monetary policy can have any impact at the zero lower bound, some of my discussion today is going to focus on, I think it actually has been quite effective. So where are we right now relative to where we were when we started this program? The unemployment rate is now 7.5%. That's much lower than where we were at the September meeting. And the payroll employment growth, while it's been a little bit uneven, we've been growing at 200,000 jobs over the last 3 months, over the last 6 months. Again, it's up and down a bit, but the average through that period is 200,000 jobs. Now, I would highlight that that is despite the fact that fiscal policy has been a little less stimulative than we might have expected going into the forecast as of September. So we didn't fully anticipate exactly what was going to be happening with fiscal policy, in particular when the tax increase would occur, and in particular when the sequester would actually occur. I think at the time that the sequester was being negotiated, both sides of the aisle thought that it wasn't a good proposal, and so we weren't going to get it. And of course, we ended up with a proposal that nobody liked, but that's what we have. So given that, fiscal policy's been a little different than we might have anticipated, and despite that, the economy's been doing pretty well. So what does that mean for the large-scale asset purchase program? Well, the large-scale asset purchase program was designed to be focused on economic outcomes. So you can see from that first bullet, the program's designed to continue until there's substantial improvement in labor markets. We didn't define what substantial improvement in labor markets was, but it was certainly significantly lower than 8.1% that we were seeing at that time, and presumably stronger payroll employment growth than we were seeing, which was averaging a little bit under 150,000 prior to that meeting. So we need to see improvement in labor market, so it is economic based in terms of when we were going to either slow down or stop the program, and that the benefits of the purchases had to outweigh the costs. So the costs get at things like asset bubbles, are you seeing disruptions and unintended consequences from these purchase programs. So my own personal view is that the accommodative monetary policy, the program has been very beneficial. We're seeing it as having an impact on housing and auto sales, and that the costs, at least to date, have been relatively modest. So my own assessment would be that the benefits significantly outweigh the cost to date. We definitely have seen improvement in labor markets, but whether it's substantial or not is something I'm going to talk a little bit about over the course of the next several slides. It's really important that the Fed continue to be attuned to what's happening in asset markets, that we aren't seeing bubbles developing in particular areas, but my own assessment is, at least to date, that most of the prices are reflecting fundamentals. We're not seeing excessive movement in asset prices that should be relevant for monetary policy. So we have an option to make adjustments in this purchase program. Most of the market right now is focused on making adjustments down, but I would highlight that we could also make adjustments up if unexpectedly the economy doesn't grow as much as expected. And I would highlight that you don't necessarily want to have a situation where monetary policy moves like an on-off switch. You'd much prefer a dimmer switch. Well, one of the nice things about a large-scale asset purchase program is it can operate more like a dimmer switch than an on-off switch. So it is possible if the economy does better than we're expecting or starts progressing so that we're more confident of a good outcome, we can dial it down. And if the economy turns out to disappoint, if we get a shock from abroad or some other shock, we can dial it back up. So many people are treating the current large-scale asset purchase program as if it's an on-off switch. One of the points I want to highlight in this is it really is a dimmer switch. It can move in both directions. As the economy improves, we should probably be scaling back the amount of purchases we're doing. But if it turns out that we don't continue to get the kind of underlying growth in the economy we want to see, then we can dial it back up. So this first chart, I'm going to go through quite a few graphs, so you'll have to bear with me. If you look at this first chart, there are two sets of forecasters. On the left is the blue chip forecasters. On the right is a survey of professional forecasts. I'm taking it starting in September of 2012, which is the decision we made the large-scale asset purchase program. What the forecasters are predicting is what was the unemployment rate going to be at the end of this year. So we still don't know what the unemployment rate is going to be at the end of this year, but this just tells you, has the outlook for labor markets changed? And at least from the private sector, it has. So if you look at the blue chip, thinking that August was 8.1%, you can see in September they were expecting us to only make a 0.3% improvement. They were expecting at the end of this year we would be at 7.8%. Now the economy has improved on the upside, and we've been having very accommodative monetary policy. As it's been working the way we had hoped, you can see that the unemployment rate has been, their forecast for the unemployment rate at the end of the year is now at 7.4%. Similarly, with a survey of professional forecasts, which is quarterly, it's gone from 7.6 to 7.4. My own forecast since the beginning of the year has been 7.25, a little bit less. So over the course of this year, I've been a little more optimistic than the private sector forecasts. I continue to be a little bit more optimistic than most private sector forecasts. Looks like we're going to get roughly 2.25% growth in the first half of the year in terms of GDP. I'm expecting the second half of the year to be stronger, closer to 3%. That would be sufficient to hopefully bring the unemployment rate down by a few tenths more. We'll see if I'm right or not, but clearly the outlook for unemployment's improved. This next looks at the inflation rate. So again, it's structured in the exact same way as the other table, except now we're looking at the inflation rate. They forecast two different inflation rates that tend to move together, but are a little bit different. The blue chip forecasts the CPI. The survey of professional forecasters looks at the Personal Consumption Expenditure Index, the PCE index. So it's the total, so this includes food and energy prices. You can see as of September, they were expecting roughly 2% inflation over the course of this year. But actually, we've had very good news in terms of inflation. Inflation's been coming in much lower than people anticipated. And you can see as you've gotten into May, the forecast for inflation, for the inflation rate over the course of this year, is now much lower than it was. For the PCE, it's at 1.4%. For the CPI, it's at 1.7%. I would say that the actual inflation numbers have been coming in lower than these forecasts have been anticipating. My own sense is that we'll actually have even lower inflation than what's incorporated in the private sector forecasts. So I think the economy is going to be pretty strong. Unemployment rate is going to continue to come down. And the inflation rate is going to be well below our target, which is at 2%. So the private sector thinks we'll be below 2%. I also agree with that assessment, and I actually think we'll be a little bit lower than they're anticipating. So what has the Federal Reserve been doing? Again, a little bit of a complicated chart, so I apologize for that. What this is the balance sheet of the Federal Reserve. Prior to the crisis, I never would have shown the Federal Reserve balance sheet because it was a straight line and it was really boring. We held Treasury securities and it just went up very gradually, year in and year out, as people needed more currency. Unfortunately, since the crisis, it's become much more interesting. So that gray area is the area that's related to the discount window and the area that was related to our unusual lending programs around the fall of 2008 when Lehman failed. So when Lehman failed, we dramatically increased the various liquidity programs that we had. The purpose was to get functioning of the market. The programs were designed so that as the market started functioning, nobody would want to come to our discount window for those liquidity programs. And you can see over time, it's dramatically come down. As it's come down, we've started a different program, which are these large-scale asset purchases. And you can see the, I guess, light blue or baby blue. Those are the mortgage-backed securities. So we've substantially increased our mortgage-backed securities. And we've also been increasing Treasury securities, particularly at the longer duration. So you can see we're holding almost no short-term Treasury securities. We're holding a lot of long-term Treasury securities. The purpose of that is, again, pull duration out, flatten the yield curve, encourage rates that are relevant for people that want to buy houses to be lower than they otherwise would be. So that was the nature of what we're doing. And if you look at the far right, that slope of that line is reflecting $85 billion a month. So as long as we buy $85 billion a month and it's an open-ended program, it would just keep going up. Now, if we decide to make an adjustment to that, instead of 85 billion picking a smaller number, it's going to affect the slope of the line, but it's not going to shrink the balance sheet. Our balance sheet will continue to grow as long as we're purchasing more mortgage-backed securities and Treasury securities until we actually stop the program altogether. So since it's an open-ended program, if I go from 85 to some smaller number, if I don't give you an end date, it doesn't really tell you whether my balance sheet's going to be larger or smaller. In order to know what the size of the balance sheet's going to be, it's tied to what is substantial improvement in labor market outlook. So the economic outlook has to continue to improve for us to actually stop the program. So if we were to dial down the program, in the longer run, the program may be less than if we didn't dial it down, but it requires to continue to get that progress on economic, getting the unemployment rate to continue to come down for us to actually stop the program. So it's a little bit different than the way you normally think about these programs. The previous two programs, we had an end date. These programs don't have an end date, so the dialing up and dialing down of the flows is a little bit different than if we had an end date and we were dialing up and dialing down the inflows. This is I promise this is the most complicated chart, and then they get easier. So I have an x-axis and a y-axis. Along the x-axis, which is the horizontal axis, it's the PCE inflation rate minus 2%. 2% is our inflation target. So if inflation is above our target, you'd be on the right half. If inflation was less than the target, you'd be in the left half. On the y-axis, I have the unemployment rate relative to estimates by the CBO of full employment. The The CBO currently estimates full employment to be 5.5%. We're currently at 7.5%. So when unemployment rate is higher than the CBO, we're in the top quadrant. So if we have inflation below target and we have unemployment rate above where the full employment estimate is, you should be in that left quadrant. Now, ideally, we want to be right at the intersection of these two lines. The intersection of these two lines would be inflation's just at 2%, and we're at full employment. If you look at the three red triangular diamonds, those three red diamonds are the most recent quarters. And in fact, the red diamond to the furthest to the left is the current period. So you take 7.5 minus 5.5, you get a 2% unemployment rate. And if you take a 2% inflation rate and you subtract a 1% inflation rate, you get 1. And you see that's at 2.1. So that's where we are right now. So what do I want to get from this chart? Well, first of all, we're much lower than where we were before. So we had much higher unemployment rates before. We were way above our target. But we're still pretty far away from our target. So while labor markets have improved, we're still not at the intersection of those two lines. Similarly, in terms of inflation, we're still pretty far to the left. Now, it's a little hard to see in this chart because it's using total inflation measure, and that includes food and energy. And we've had a number of food and energy shocks over the last 2 decades. So some of the observations that are extreme in terms of inflation are reflecting the fact that we had oil shocks over the last 20 years that make the inflation rate seem much higher. So in order to correct for that, or not correct for that, but to adjust for that, you look at the core inflation rate. Whenever I show a core inflation rate, people say, why doesn't the Fed care about food and energy? We do care about food and energy, but we can't control whether somebody decides to bomb Iran. We can't control whether the sun shines all through the summer and we have a drought. There's certain things that the Fed just doesn't control. So by looking at the core inflation rate, it's trying to get at things that hopefully get at the underlying inflation rate. If you look at oil prices, they tend to be somewhat mean reverting. And so what that does is it takes the extreme observations on inflation out. And what you can see is during the periods of high unemployment, we've systematically undershot the 2% inflation rate. All the observations are on the left half of this chart. So we've been systematically hitting below 2% inflation during the period where we've had a very high unemployment rate. And you can see that during the period of the Great Moderation, so looking back a little further, that we were really quite clumped around hitting our target. We were doing pretty well at hitting both the inflation and the unemployment rate goals, but we obviously didn't do so well during the midst of 2007, 2008. We've definitely moved down in terms of the unemployment rate, but if you look at the triangle that's to the far left, you can see that we're pretty far below our inflation target. So it just highlights that while there's been progress, there's a lot more progress that we need to get the economy restored to where we really want it to be. This next chart tries to give the same information with more of a historical context, less of a scatter diagram, but gives some of the same kind of information. So this is the total inflation rate over the last 30 years. So the last chart just looked over the last 20 years. This chart looks over the last 30 years. The shading reflects recessions. So those are the periods where we had recessions. And the dark black line isn't the inflation target. The inflation target's 2%. The dark black line is showing what the most recent observation is. So the most recent observation for PCE inflation is 1%. 1% is well below 2%, but this gives you the context of historically how have we done. The only period that we've been substantially lower than the current inflation rate for total inflation is in the midst of the very severe recession that we had when oil prices came down quite dramatically. If you look at the core inflation rate, which takes out the oil shock, or the oil shocks that were occurring during that period, the current core PCE inflation rate's at 1.1%. Again, that's well below the 2% inflation rate. But you can see that we're basically at the lowest point that we've been over this 30-year period. So core inflation remains quite low. How about unemployment? This shows you the unemployment rate. Again, the dark line is reflecting what we're currently at. We're currently at 7.5% unemployment. So you can see as a result of the Great Recession that we had, the unemployment rate got very high. It has come down substantially. That's just indicating the kind of improvement that we've actually been experiencing. But if you put it in the context of the last two recessions, we're still pretty close to where the peak was of 2 recessions ago, and we're still well above the worst point in the last recession. So while the unemployment rate is improving, relative to the last 2 recessions, this doesn't look so good. So we still have a long way to go. So just to summarize the set of charts that I've just run you through. First of all, in terms of inflation, we're well below the 2% target, whether you use total or whether you use core. That actually gives us a fair amount of latitude to be more accommodative and try to get the unemployment rate to come down more quickly than it otherwise would. There are very large costs to having unemployment rate elevated for long periods of time. It's much harder to get people back to work if they've been unemployed for an extended period of time. So it's desirable to try to get the economy to grow faster. So it really helps that inflation rate is well below target. Labor market has definitely improved. We're nowhere near where we were at the peak of the recession, and we're nowhere near where we were around August of last year. Nonetheless, we still remain at a point that's very close to the peaks of the last 2 recessions, so we're far from done. Now, we have to think about the potential unintended costs of our accommodative policy, but by and large, and we can have a discussion of this if there's some questions about it, I don't think the unintended consequences have been so large to outweigh the reasons for why we're doing the accommodative policy. And as a result, I think the significant accommodation remains appropriate at this time. Now, in terms of thinking about substantial improvement in labor markets, it's not tied to the unemployment rate. It's not tied to payroll employment because you want to look at broadly what's happening in labor markets. So you can look at a variety of employment statistics, but this chart shows you what the differences are across the country. So ideally, substantial improvement in labor markets would be, it's not just a few states, it's not just California and New York, that we're actually seeing some improvement across the country. So what this chart looks at is the change in the unemployment rate from last September compared to April of 2013. The dark green is good news. That's a decline of more than 1%. The light green is 0.5 to 1%. The yellow is 0 to 0.5%. And the red is an increase in the unemployment rate. So if I was showing this chart back in 2008, everybody would be red. Fortunately, we're not in that position anymore. So you can see that there are actually quite a number of dark green states. And it's kind of interesting which states are dark green. So you look at Florida, you look at Nevada, you look at California. Those are the states that were the perennial worse off of the states that we have. So they were really hit by the real estate cycle. Not surprisingly, as the housing sector's improved, those parts of the country that was most affected by the residential real estate cycle are the ones that are showing the most improvement in terms of labor markets. So it's good news that we're seeing that. And we're only seeing a handful of states that since last September haven't improved. Now, one reason an unemployment rate can come down is that people pull out of the labor force or that people decide to move to another state because they can't find a job. So another way to think about this is to look at payroll employment. This chart is a little bit different than the last one, but gives roughly the same information in a slightly different way. So the dark green here, again, is still good news. So the green is good, red is not so good. Green is larger increase in employment in the labor force. So you're growing the jobs faster than your labor force is growing. The light green is you've increased in employment, but your labor force didn't increase. The yellow is a smaller increase in employment than you got in the labor force. So the labor force has grown, but you're not employing people as quickly as the labor force has grown. And red's an actual decline in employment. The same pattern as before, the states that have been hardest hit, such as California, Florida, Nevada, are among the states that are all dark green, so that's good news. Much of the country, or many parts of the country, are dark green. It's pretty widespread. Again, there are only a couple of states that are red. There are only a couple of states since last September haven't shown fairly dramatic improvements from where we were last September. So this is a way to say it's relatively broad-based. We actually are getting an economy that is improving. I promised you an optimistic talk. This is an optimistic talk. That most parts of the country are doing better on the employment picture than what we were doing last September. This is exactly the kind of pattern you'd want to see from monetary policy having an effect. You'd want to see those states that were most impacted by the housing cycle doing better. That also happen to be the most interest-sensitive sectors, so the states that are most sensitive to the interest cycle. And so by and large, monetary policy is doing what we want it to do. It still begs the question of at what point do we want to scale it back down? So this just summarizes, since last September, there's been improvement. Most regions in the country now are better than they were when we started this program. So we're really beginning to get the positive impact in virtually all regions of the country. So that's all very positive news. Nonetheless, we remain pretty far away from where we want to be. 7.5% is not full employment. So we're still pretty far away from our actual full employment level, and we're still quite a bit below the 2% inflation target that we have. In my view, it would be premature at this time to stop our asset purchase program. We should wait until we see a more sustained improvement in labor markets and until we have greater confidence that the economic recovery is really self-sustaining. But it is undesirable to just stop our purchase program as an on-off button. I do think we should treat this more like a dimmer switch. So as we start seeing more evidence that the economy really is improving, as we're getting to a place where everybody would agree that substantial improvement in labor markets, we do need to make some modest adjustments. Just because we reduce the flow doesn't mean necessarily that the entire balance sheet is going to be any smaller or any larger. For that, you have to know what the stopping point is. But if we continue to get progress as you dial down the flow, you'll eventually stop the program and we'll no longer have the large-scale asset purchase program. But I would say there are other elements besides the large-scale asset purchase program. So a lot of analysts are focused on the size of our balance sheet, but we also have short-term interest rates. So we have thresholds for the short-term interest rates that we're going to keep the short-term interest rate at 0 until we see 6.5% unemployment or lower, unless we start seeing a bigger pickup in inflation to 2.5%. So we still have the fact that short-term interest rates are bounded at 0. So we still have a long way to go before we completely normalize interest rates. But nonetheless, I think we do have the tools that we need. Exit from accommodative policy is always difficult. We've not always gotten it right in the past. It's difficult to do even when the only tool that you have is the Fed funds rate. And markets can always overreact to what we're trying to do. One of the reasons I give these talks, and Ariana gives these talks, is we try to be as transparent as we can about what we're trying to do. But nonetheless, you can have market reactions that are much larger than what we might have anticipated. Overall, I think we have the flexibility, though, to make adjustments up or down, depending on how the economy evolves. So, changing the flow of the balance sheet doesn't necessarily yield movement in the balance sheet overall. I do think that when we stop, we need to have very clear evidence that we have had the substantial improvement we want to see. Bottom line is I want to see stronger growth than the 2.1% average growth rate that we've been having. Told you that the first half of the year I'm expecting it to average out to about 2.25. That's not all that much different. So we really want the second half of the year, the growth to be stronger than what we've been seeing over the course of this recovery. So that concludes my remarks, and I'd be glad to take questions.
Stay here, I have a couple of questions for
you.
As is often the case, we don't have a lot of time for questions, but there should be microphones moving around the room. We'll try to get a couple in. First off, since a good share of this was focused on unemployment and the job growth, how do you think about the shrinking size of the workforce, the discouraged workers, the underemployed workers, and what does that monthly job growth rate need to be? It's been averaging about 200,000. What does it need to be as we go forward?
I mean, ideally, we'd very consistently be seeing growth above 200,000. So while we've averaged 200,000, it's usually 2 months well below and one number well above. Ideally, we'd be seeing some pretty consistent numbers above 200,000 in payroll employment. But as you say, it's labor market conditions we're focused on. There are lots of measures of labor market conditions. So we don't just focus on the unemployment rate. We do worry about discouraged workers. We do worry about people that have been out of the workforce because they can't find a job. So we look at the other measures of unemployment as well, which is why it's labor markets more generally. It's not tied to an unemployment rate. It's not tied to a payroll employment growth. It's tied to looking at the full constellation and saying, can we really credibly say that the labor market is healed sufficiently that it's time to remove the accommodation?
And taking the prerogative of the chair, one last question from me, and then we'll go to the others. You referenced unintended consequences several times. You didn't delineate. What do you worry about the most?
So the unintended consequences could be a situation where you start seeing bubbles emerge, that you start seeing so much risk. So part of what we're doing is we're encouraging risk-taking. We're making things like Treasury securities be relatively low rates of return. That encourages investors to get into riskier assets. That is the intent of monetary policy, but we don't want to overdo it. So if everybody is putting everything on red and hoping it turns out all right, that wouldn't be all right. So if we start seeing particular parts of the financial markets that are showing that, one, they could be very disruptive if the prices was to reverse, and two, that we really have seen very substantial price appreciation, that would be the type of thing that we'd have to take into consideration with how long we want to keep interest rates as low as they've been.
With that, please identify yourself and pose your question.
Hi, Paul Cook with UBS. Explain how you view your role at the Fed with Washington and Congress and the lack of control that you have, or what control do you have over policy, specifically taxes, and the levers you don't get a chance to pull. Do you feel you have any? Explain your relationship with Washington.
So we're politically independent. We do have a dual mandate, but we don't get to control everything that affects the dual mandate. So there are things that affect inflation that we don't control. Some of that could be exchange rates, for example, what's happening in Japan in terms of their change in policy. We don't control what the Japanese decide to do for their own monetary policy. Similarly, we don't get to decide what happens with Congress and the president in terms of deciding fiscal policy. So we basically have to take that as given and try to get monetary policy to be as consistent with hitting our dual mandate as possible, given those constraints. So we'll have forecasts for what we think fiscal policy is likely to be over the course of the next couple of years. We'll have assumptions about what we think foreign growth and foreign exchange rates will be, knowing that there's a big forecast error because there are unintended things that can occur. So if we hit the debt ceiling and we have a dysfunctional discussion around the debt ceiling, for example, you could imagine we won't do as well if we have that kind of outcome. Similarly, we won't have as good an outcome if Europe were to have a problem around one of the elections that are occurring in the fall, for example. So there are a number of things that can cause us to move away from where we think we're going to go that are pretty much independent of monetary policy. So we take those variables into account. We try to make an adjustment. So if fiscal policy is going to be a lot more restrictive, all other things equal, we should have a more accommodative monetary policy. If fiscal policy is being less restrictive, then you might not need the same degree of accommodation for monetary policy. So while they aren't coordinated, you do have to take into account what's happening with other things, including fiscal policy.
Is there someone else here? We've got the microphone out in the audience. We'll go two final questions, and then we'll have to wrap it up in the interest of time.
Hi, Bill Parker, U.S. Bank. With the significant run-up in rates that's occurred just in the last few weeks, is the asset purchase program responsive to that, or is it more reactive depending upon what happens with the economy?
Well, that's the nice thing about having a program that's tied to economic outcomes. So our purchase program is tied to getting substantial improvement in labor markets. If interest rates were to go up enough to slow down the economy, it means we're going to do the purchases longer than we otherwise would. So it's not so tied to what's happening in financial markets in terms of movements in interest rates. It's tied to what we're seeing in the real economy. That's true both for the large-scale asset purchase program, which is tied to the labor market outlook, but it's also true for when we raise the short-term interest rate. So I think in some sense, we've insulated ourselves a little bit from some of those concerns. People need to look at the economic outcome to figure out what we're going to be doing for monetary policy, and I think that's appropriate.
And one last question from David Frauenschuh, who's been a leader of the Economic Club.
So it might be a real dumb question. What role, when you are trying to move the economy ahead by stimulation, and at the same time government is over-regulating, does that not defeat the purpose of what you're trying to do? Because the bank is, to do it, you need the money to move through lending institutions to get the economy going. And if the banks are being over-regulated, doesn't that defeat that purpose?
So bank regulation, other types of regulations, healthcare legislation, there are lots of regulations that could potentially have an impact on what economic growth is going to look like. They potentially could be at odds to what we're trying to do with monetary policy. We have to take that into account. My own assessment is, by and large, when I talk to bankers, they have the capacity to lend. There can be a disagreement. Usually borrowers and lenders don't have a complete agreement on this, but most companies, when I meet with small businesses and medium-sized businesses in New England at least, if they have a pretty good balance sheet and weren't too impaired from the Great Recession, they're actually getting funding, and there's a lot of competition for those loans. So my own assessment is right now that if you are a pretty good credit, you're going to be able to find financing from a bank. So I don't think it's impeding the recovery in a significant way. But I take your point that government regulations, depending on where they're coming from, may work at odds with monetary policy, and we just have to deal with that as best we can to try to get the right. Congress gave us a mandate. Our goal is to try to hit that mandate. If other things impede that, we just try to overcompensate for that.
It goes back to the point you made in your discussion or in your presentation that they don't always match up.
Right.
Which is frustrating, I'm sure. With that, I want to present to you, and right behind you is the bag which holds our world-famous Economic Club paperweight.
Thank you.
And with that, I want the audience to thank you once again for your great presentation.
Thank you very much.
The Economic Club of Minnesota's mission is to provide a world-class, nonpartisan forum for national and international leaders in business and public policy to discuss ideas that affect how Minnesota can better compete in the global economy. The Economic Club of Minnesota, engaging the world, strengthening Minnesota.